Welcome to Your Money Today, a unique look at financial, geopolitical, and other news relevant to you. For 45 years now, your host, Chris Temple, has provided his one-of-a-kind insights and advice on the markets and on our world. Whatever the subject, he calls them like he sees them. Roll up your sleeves with Chris as we get into today's program.
Welcome back, folks. This week I'm going to give you both an audio, and for those watching this via video, you'll see some charts and graphs and so forth. Not a lot of them, but some that'll help explain. I'm going to give you a synopsis of a much more comprehensive special report that's going to be out right on the heels of this episode of Your Money Today. As you can see here on the screen, the title of it is "This is Still Not Your Father's Gold Market." So today we're going to talk about all things gold, some of them involving silver as well, but predominantly gold. A lot of overlapping themes and approaches that we have to take toward both of these monetary, or in silver's case, quasi-monetary precious metals. And this is a report that I have updated from time to time in recent years. Usually I'll do it once every 12 or 18 months or so. The hard copy, if you are not already on my list, I'll be sending that out imminently. So if you're not already on my list, make sure you sign up. The information is here on the screen. It's also in the notes to this show, wherever you're watching it on, whether on YouTube or on your favorite podcast channel. And also for those of you who are listening in or watching on YouTube, please make sure, as always, that you like the video. If you're not already a subscriber to my YouTube channel, make sure you do that as well, so that from time to time when we have new content on here, which is going to be pretty fast and furious, as the new president, we're recording this on Friday, January 17th, next Monday, the new president, or renewed president, is going to be sworn in, and all the fun is going to start, so to speak. So you don't want to be caught behind on whatever developments that is going to cause in all markets, including where the gold market is concerned. Now, over the years, one of the pitfalls that a lot of investors have had, if they have been interested in precious metals, if they've invested in this area, especially in stocks of companies exploring for or even producing precious metals, and this is not true just with mining stocks, but we're going to focus on these today. You know, it's been a combination of promise and peril. A lot of money has been made over the years in a lot of mining stocks. Much more money has been lost by bad stories, bad decisions, bad timing, whatever the case may be. We're going to unpackage all of that for you in this issue of Your Money Today and talk about what to do, what not to do. I'm going to give you a part history lesson. It's going to be part deprogramming, if you will, for those of you who are some of the more religious gold and silver bugs out there. Part of the reason why I have found for a long time now that a lot of people have had bad experiences investing in precious metals is that they have become, frankly, too religious about that theme. You know, you don't want to get religious and dogmatic about any investing theme. Times change, circumstances change, markets change, and a lot of people who are just 100% gold 100% of the time have not done well for a long time. And this is even as gold price, which you're going to learn in just a few minutes, still, even though a lot of people denigrate it, has been among the leading assets since gold itself once again became an investable asset way back in 1971. We're going to get into some of that history and why it's important in just a second. You know, even in the recent past, a lot of people have been left wondering what's going on, what's wrong, who's manipulating what, and things like that, especially when you look at the universe of gold stocks out there. In 2024, gold had a darn good year. Interestingly enough, as for a good part of the time, the US dollar was racing higher, and even interest rates, long-term interest rates, after coming down, moved higher as well. We're going to talk about that as we go along here as well. Yet most gold investors, especially if they focus farther down the food chain on their favorite exploration stories and so forth, didn't have a good year because most of those kind of stocks ended up lower on the year, not higher, number one. If they started out well, and there was a spurt early on in 2024 where a lot of these kind of stocks did well, many of them gave all of that back and then some to end up negative on the year. Doesn't mean they're bad stories. It means that in a lot of different ways, broad markets had a lot to say about this. And here again, this is something that confuses a lot of retail investors who have some kind of an affinity for gold and silver, or maybe pick that up in more of the recent past because of a lot of good reasons we're going to cover that they should be interested in that. But here again, if you don't know what you're doing, or you follow people who don't have your best interests at heart and are giving you a song and dance and conspiracy theories and so forth, you're not going to do real well in this space. So here again, we're going to deprogram those of you that need it. We're going to give you history lessons. We're going to give you a very matter-of-fact primer here, if you will, in this relatively short time, as to why you should be interested in precious metals, why they are actionable today, even after the big move that gold had last year. Silver didn't quite keep up, but that'll change with time. And what it's going to take in the next, and I think we're talking about potentially months rather than years, what it's going to take to get more investors on this bandwagon and look at precious metals again, because frankly, when we look at the universe of people out there who drive this market, it's pretty tiny. One statistic I've used many times, I'll mention it here just because I'm on that subject. If you go back to 1980, when gold hit its first peak of over $800 an ounce, only stayed there a few weeks. But during that time, and it was a time of rampant high inflation, but importantly, and this is one of the reasons why I title my work on this is still not your father's gold market. Back then, if you look at the peak valuation of all mining stocks as a percentage of the broad stock market, it was over 20%. The gold part of that was, I think, half or more of that at the time, because gold was suddenly hot. Today, you need a magnifying glass to look at the allocation, for instance, of gold stocks compared to the broad stock market if you look at the S&P 500, because of the ensuing 45 years or so since then. The broad market, sectors sometimes deserve it, sometimes they don't, but the broad market has gone way into the stratosphere. And in relative terms, people just don't pay that much attention or invest in precious metal stocks in relation to the rest of the markets. That changes from time to time. It will change again. And so if you're holding good companies, don't lose heart. If you think that opportunity is past to invest in precious metals, you're wrong. And we're going to explain how and why that is, and more importantly, what to do and what not to do as we go along. Now, sometimes precious metals investing has gotten a bad rap over the years, mostly from some of those I refer to from time to time as the Pied Pipers of the gold bug echo chamber, who are a little bit too outlandish sometimes for their own good, and they don't make the sector credible to the 99% of people out there, perhaps most of you watching this, who are not automatically dyed-in-the-wool gold or silver bugs. And look, I believe in gold and silver both as investments. I believe in them both as money. Both of them for thousands of years have been one of the chief types of money that people have used as a medium of exchange. Certainly not the only ones. There have been, for those who have studied monetary history, all manner of substances and scrip and whatnot that people have used. But silver and gold alike have had properties for millennia that people have embraced to realize that they're worthwhile to use as a medium of exchange, to use for adornments, for jewelry, to show vast wealth, and all the rest of these things. So it's not like precious metals should be a mystifying type of asset class to worry about, quite frankly, and I know that a lot of people these days would disagree. I think they're a lot easier to get your head around than a lot of the valuations for artificial intelligence stocks that nobody can really put their finger on what they're even talking about when it comes to some of this stuff. It's only that everybody else wants them, so I want them too. And you can say the same thing about cryptocurrencies and that kind of thing. In the written version of This Is Still Not Your Father's Gold Market, I go into a little bit more detail about why you need to distinguish between precious metals on one hand and cryptocurrencies like Bitcoin and some of the other ones on the other hand. I think that two very different types of people are investing in those. And so from time to time, when your favorite gold bug, for example, if you are a gold bug watching this, might blame Bitcoin for your gold holdings not doing that well. That's an excuse. It's not an explanation, because they're different types of investors, I think, who to get into these things. So beyond the monetary aspects of gold, why do people buy gold? What is the use for it? Well, over the years, gold has been used for typically two different reasons, whether it's a monetary asset, and sometimes individuals will buy gold and silver coins to have on hand, to have as an asset in physical form, or they're used for jewelry. Gold specifically, for the longest time, if you looked at the equation when I first got interested in this space well over 40 years ago and was looking at the differences between jewelry and investment demand, it was pretty much two parts jewelry demand or other fabrication, some of it industrial and whatnot, and one part investment demand. Now, in recent years, and especially when I get to this point in my brief history lesson, particularly when you get to the year 1999 and things changed a lot where central banks were concerned, that was a pretty static formula. But since that time, jewelry and other fabrication demand, I mean, people, Joe Pesci, his character on Home Alone, of course, had a gold tooth partly knocked out, and that is what people use gold for a lot in times past. It's used for electronics. Silver, of course, has a lot more industrial type uses, I think, than gold does, but they both have got some application, not the lion's share of the demand, to be sure, but some of it. And in fact, whatever you are listening to or watching me on right now has likely got silver and gold in tiny quantities as part of the mix, whether for conducting purposes or whatever the case may be. So along with other rare earth and various other metals, you have precious metals in your device, whatever it is that you're using right this second. But again, over time, the demand on a part of central banks for gold as a reserve asset, once again, after many years of net selling of gold, mostly by Western central banks. That has been a big part of gold's story since 1999 and 2000, when we had a major low in the gold price back then. And more recently, we have seen what is even more fickle demand on a part of investors. In fact, if you look at the instances since the year 2000, when gold and silver had their biggest moves, but then unfortunately biggest busts, especially in the case of the equities tied to gold and silver, it's been when you've had a much bigger presence of generalist investors that come in for what have proven to be fleeting interludes. When they come in and when they leave, it can have an outsized effect because, again, as I pointed out a few minutes ago, the size of the market for precious metals, and precious metals equities particularly, is a pimple on a flea these days compared to what it used to be. Now, the modern age of gold investing per se started way back in 1971, and a lot of you, or most of you, I'd suspect, know this, at least generally from history. It was in the summer of 1971 that then President Richard Nixon ended the convertibility of the dollar into gold, and this was at the time for foreign holders. At the same time, as part of this whole process, he freed up gold, which at the time had been capped at a mandatory $35 per ounce valuation for all public and monetary purposes. He unmoored gold, as some would call it, and allowed the gold price for the first time since the Depression, when Franklin Roosevelt had done the opposite. He allowed it to be traded freely and priced freely in public markets. That started the secular bull market, which has had a few different manifestations since that time. And it started also the very inverse relationship, which lasted for a long time. Still there, not the way some people, I think, incorrectly say that it is, but it started the inverse relationship between the US dollar's value and the value for an ounce of gold. You have to remember that in those days, contrary to the US of A, when Nixon's move led to his Fed chairman, Arthur Burns, debauching our currency, inflating away the value of the dollar by devaluing it basically against other currencies, and as a consequence devaluing it against gold. That's why most of the 1970s saw this near parabolic at times increase in the gold price that went along with the devaluation of the US dollar against other currencies. Back in the 70s, everybody else hadn't figured out yet how to use monetary inflation in the way that the US was more uniquely doing it back in those days. So as a result, you had the gold price go nuts. It went from $35 an ounce, had several pullbacks along the way, but up to a very brief peak in 1980, which only lasted a few weeks, of up around $875 an ounce. After that point, gold had a series of pullbacks, which ultimately saw it bottom out in 1999 and then again in 2001 at $250, $260 an ounce. So it was a generation, nearly, or technically a quarter of a century, before gold would again see the highs that it did at its peak in 1980. Now, along the way, as I alluded to a second ago, other central banks, one by one, figured out, hey, we can print a lot of money too. We can depend on fiat currency to cover for ever-increasing debts, ever-increasing fiscal imbalances, and all the rest of this stuff, to the point where long since it's been a case of a race to the bottom among fiat currencies. So in that environment, it hasn't always been the case where gold and the US dollar have to move inverse to one another. There have been notable cases along the way where that has not been true. If you go back to the Euro crisis in 2010 and 2011, you had an extended period of time where the US dollar and gold both were doing extraordinarily well together. You've had several other instances since that time. Frankly, as I said at the outset, in 2024, especially if you look at the latter part of the year, and for those who are watching this by video, I've got a couple of charts to illustrate this. Even as the US dollar has been smoking other major currencies in the world, just since September, the US dollar's value was up 10% against other key currencies. Gold has pretty much marked time. It's been going sideways, which is remarkable, and it really is, belies this idea that in order for gold to do well, you've got to look at the US dollar going down. Not necessarily. That might help in some circumstances. Of course, it depends why the US dollar would be going down as well. That's something that I get into again in a deeper way when you see the printed version of This Is Still Not Your Father's Gold Market. But when all is said and done, the only thing you've got to keep in mind is that all central banks today, for the most part, not just the Fed on the part of the US, are engaged in this race to the bottom. They're all printing lots of money. They're all running up huge debts. And, it's all, as time goes on, a story of debauching fiat currencies, which makes all real assets, not just gold, look better. But gold has been one of the leaders since all of this started, led off by the US back in 1971. At the Dow Jones Industrial Average, to pick one of the better known stock indices over time that was around back in 1971, if you look at that, it is up about 50-fold since 1971. So inflation, which really is the devaluation of currency, meaning you need more of it for everything that you're going to buy, whether it's stocks, real estate, or whatever, it makes those prices, quote, go up. The prices aren't going up. The value of the currency you're measuring them in is going down. So it's great that stocks have been somewhat of an inflation hedge over time, but in the same time, the Dow is up about 50-fold since gold became a free trading asset again. Gold itself is up darn near 80-fold from its bottom. So gold has been a great store of value. As more importantly, as we'll discuss in a moment, it's a crisis hedge. It's a hedge against fear. And now this is something that is measured ever more so on a global scale, which we're going to discuss. But again, bottom line is gold benefits when policymakers destroy fiat currencies. In fact, one of my favorite graphics that I use shows a photo of some of the core of the New York Yankees lineup from the late 1920s, anchored by the likes of a Babe Ruth in his prime and a Lou Gehrig earlier on in his career and some others. They were famously for years known by sports writers and then Americans generally as Murderers Row. Well, we've had a Murderers Row at the Fed for a while as well. So here, if you're watching this by video, you see the Fed's Murderers Row in recent years. And of course, left to right, you've got Greenspan, Bernanke, Janet Yellen, and the current one, Jerome Powell, who all have enabled profligate spending, never-ending debts, and consequently the devaluation of the U.S. dollar, certainly versus gold and other hard assets, even if in more recent times, as I've said in other contexts recently, the dollar as a fiat currency, comparing it to other fiat currencies, indeed has been the prettiest horse in the glue factory. But all of them, to one extent or another, are losing out to gold, inevitably more so to silver, and to other real assets as time goes by. Now again, and I'm going to stick predominantly with gold for this discussion, but over time you've had two general reasons why investors from time to time have looked maybe more so than usual at gold. One is if the economies are doing very well, especially the emerging economies of recent times in places like China and India, then you're going to have a fair bit more incremental demand for gold. It's because people are doing better, they're healthier, and frankly, in both of those societies that I mentioned, you've got much more of an affinity on the part of the population for gold, not only as jewelry, but to have some on hand to use as mad money. It's a store of wealth. People in India, people in China do that much more so than is the case in the West these days. And in fact, one of the underlying themes for those who have been more savvy than others in recent years and have followed the right information when it concerns gold and fund flows and things like that, is this underlying theme of much of the world's gold going from west to east. I'll get back to that in a second when I talk about the infamous Brown's bottom from 1999 time frame, where the UK sold off the majority of its gold. But again, you've got good reasons why gold does well and is in demand, more so from an investment standpoint as opposed to a love trade for gold. You've had what times, from time to time, is a fear trade. You've got a financial crisis, you've got currency crises. Indeed, a big part of 2024's move in the gold price, I think, had less to do with any outright fear over this is going to fall apart or that's going to fall apart, but just the growing realization that everywhere you want to look in the world, economies are getting to inflection points that is going to change the equation that people are comfortable with now. And then they're very different ones in some cases. And I've said this recently. I said it on the first issue of Your Money Today several days back for this year, that you've got in China the economy and markets lurching into deflation, and that may bring about a bigger crisis. And here in the U.S., you're going quite the opposite direction with still an inflationary impulse, the uncertainties of the incoming administration, what's going to happen to trade and global relations and tariffs and all that kind of stuff. And is that going to take the sheen finally off of what we all believe is an overvalued stock market? So this is part of the reason why gold did well last year, even as the dollar did well, even as interest rates shot up in the last part of 2024 as well. But I mentioned Brown's bottom, and this brings me to the story of a key inflection point that changed what had been a 20-year blah environment for gold following that manic but brief 1980 peak where the gold price was over $875 an ounce. Through the 80s and 90s, there were times that it was profitable to be a gold investor, but by and large, being a buy and hold investor all those years wasn't really a good move, and it didn't really pay you that well because, again, we saw from its peak the gold price cut by something like 3/4 or close to that when all was said and done, and it bottomed, maybe by 2/3. I'm exaggerating the number. But in 1999, the first of those bottoms came with the gold price around $250 or $260 an ounce. But then something happened that really scared everybody who had been playing a game of from time to time shorting gold, and more so in those days they were playing and trading, and I was doing it as well, for our subscribers and members here at the National Investor, playing what was called Brown's bottom. Infamously, as unfortunately for them, a lot of central banks were doing in those years, they were incrementally bleeding off their gold holdings because it was no longer fashionable to have as much in the way of gold for your foreign exchange reserves and your other reserves and whatnot as it was to have stocks and to have other things, because the 80s and 90s were notably a big decade for stocks to inflate rather than for gold and other commodities. So Gordon Brown, who at the time was the Chancellor of the Exchequer in the UK, infamously announced to everybody and their dog and their fleas on the dog every 6 weeks, I think it was back then, when he was going to sell another 25 tons of the UK's gold. And that was just one of the reasons why during a fair bit of that time, gold, even though it was still technically free trading in the market, thanks to Nixon's unmooring the gold price back in 1971, it from time to time still did trade almost as a managed asset in some ways, kind of like the De Beers cartel running gold. And I'm not going to get into all the details of this. For those of you that are interested in a really cool history lesson, and this will upset some people, the only demonstrable, verifiable time that the Federal Reserve actually acted to suppress the gold price. Okay, so if you've heard conspiracy theories to the contrary, they're wrong. Okay, the only time that demonstrably happened was in the fall of 1999, and it was a part of actually, in the end, reinvigorating what became a bull market for the gold price. In 1999, in the early part of September, there was the latest auction for the UK's gold. And as happened more often than not, you had some pretty good demand for it. So you'd have, for example, the gold price pop from 250 or 260 an ounce, maybe up to 300, 310 an ounce, somewheres in that neighborhood. And then people at that point would bet against it. They'd short it, push it back down, take profits, whatever. And then it was kind of rinse, repeat. This happened a number of different times. But later in the month of September in 1999, there was something happened that nobody anticipated. And that was on the sidelines of a World Bank meeting in New York City, what was called the Central Bank Gold Agreement back in those days was reached. And this put a lid on the amount of gold that central banks would be able to sell and or lease into the market. Because up until that time, one of the reasons why gold couldn't rally, even if it had otherwise strong fundamentals, is you always had this sort of Damocles hanging over the market that everybody's afraid to go long, to buy gold and stock up on it, because you didn't know when the next central bank was going to push the price back down. And interestingly, in those days, what we might today call a woke type of reason was a big part of the justification for this agreement, because in countries, for example, like South Africa, where you've got a lot of South African labor that works in the gold mines and whatnot, and this is true elsewhere in Africa and other parts of the world in some ways, back in those years, you had people losing their jobs because mines had to sometimes curtail production or shut down because the price was always working against them, even as their costs went up. So part of the sales pitch to get the industry and central banks to be more supportive was that we can't have this situation anymore where all of these paper traders, and just in those days you had that too, are suppressing the gold price and put miners out of work. So this blindsided everybody. And this time around, the rally that had already started from the latest UK auction earlier in September going well took off, and everybody was caught on the wrong side of it. The gold price went up at one point to 340 an ounce. And on my website, those of you following by video will see a couple screenshots here. If you look at the commentary section and scroll down, I've got a couple of pieces about what one of them is called the Great Gold Caper of 1999. The other one talks about this was true gold manipulation. But it was quite a fascinating time to be in the gold market, especially if you were on the right side. But more importantly, it started to change in the biggest way in years the investment narrative, because now gold was going to be net bought by central banks as time went on. They were not going to be net sellers forever, and over the years that has been true. And one of the reasons why gold in the 25 years since then, the reason why, a big reason, it has done well and gone from $250 an ounce multiplied by more than tenfold since those bottoms. And we had the bottom that reached in 1999, went back up, took a little while to make a second bottom in 2001, but then it was nothing but uphill for a long time after that, with a few pullbacks. But this is because the biggest detriment, central bank selling, had now become a positive. And that by and large has remained the case. In fact, in the last several years, you have seen even more of an impetus on the part of central banks to buy gold, even if they can't buy it any longer from Western governments like the UK, which doesn't have any left to speak of. Switzerland even sold most or all of their gold. The Bank of Canada did it, and others have done it. So now the central banks are looking out in the marketplace. And this is not because, and here's another fantasy that's told by a lot of people trying to scare you into buying gold, and usually the wrong kind of gold investments. It's not because China or Russia or the BRICS nations or somebody can even come up with a so-called gold-backed currency. But these central banks, nevertheless, in Russia and China and Turkey and elsewhere, have been buying gold because they know that over time this is going to be a great and profitable diversifier, if nothing else, for their foreign exchange reserves and their national reserves otherwise, because everybody's fiat currency over time is going down, and they know that they're not going to lose over time with gold. So one of the very first things, in fact, folks, that I'll say to somebody who I'm having a discussion on gold with, and they, oh, you're one of them? I say, no, I'm not one of them. And I explain why. I'm not a typical gold bug, certainly not one of the storytelling Pied Pipers, but my retort is, if Russia and China and other central banks are doing this, if wise hedge funds and wise sophisticated investors even now are starting to reallocate part of their portfolio away from overpriced stocks and so forth, and they're all interested in gold, maybe there are reasons why you should be interested too. Now, even though central banks have been a very net positive influence, and more consistently so, as time has gone on after that pivotal central bank gold agreement back in 1999 was reached, much more fickle has been the interest of investors. Now, there have been times when gold and gold stocks, getting pulled along with it, have done well. Same thing with silver. The biggest example, and frankly, still to this day, the enduring peak for gold and silver equities was way back in 2011. And that was at a time when gold had gone, it had finally touched $1,000 an ounce, not the nominal price, a new high in 2007. But then everything initially got hit when the financial crisis came in 2008. I don't care what it was that got sold off, including gold, which briefly got pushed back to under $700 an ounce. But the reason was that a lot of people had borrowed dollars in order to be able to buy gold, and they had to quick reverse those positions, because for a while the dollar skyrocketed as a flight to safety when everything started to unravel in 2008. And if you were leveraged and you were an investment house, you had to sell whatever you could to be able to get unleveraged and cover your dollar bets, and that included by selling gold. But notably, gold was one of the first things that bottomed, and from its bottom in late 2008 until gold itself hit a peak in the fall of 2011. The equities peaked at the beginning of the year in 2011. We were already selling them back then. But in less than 3 years' time, the gold price tripled. And I always like to remind people, or explain to people as the case may be, it wasn't because gold bugs got excited, it was because everybody else did. And that's an instructive lesson for us today. What was it that caused generalist investors to start piling in a bigger way to precious metals. Silver hit a $50 an ounce peak in sympathy with gold back in 2011 timeframe. What caused that? It wasn't because gold bugs were buying. I mean, gold bugs by definition perpetually they're always up to here with a portfolio full of precious metals investments of all kinds. Gold bugs don't move the needle at all for the most part when it comes to the precious metals. Maybe incrementally when it comes to breakout stories among mining equities from time to time. But what causes the needle to move is when investors that aren't thinking about precious metals 24/7 see something so compelling that they can't ignore it anymore. And what they saw back then, and again, this is instructive for where we are today, folks. What they saw back then was that after the financial crisis, led by the Fed, central banks started printing lots of money, but the Fed was really outdoing everybody else for a while back then. But the damage was so great to the underlying economy, to the real estate market, because of the mortgage and real estate bust and everything that really started all the dominoes falling, that all of the interest rate cutting and the dollar printing and so forth early on really had no traction. For every dollar the Fed created, the markets had already vaporized $10 or more in lost valuations of real estate, of stocks, of everything else. And so disproportionately that benefited precious metals because investors looked at this equation and said, okay, the Fed printing money right now is not helping the economy, it's not helping real estate recover, it's not getting the stock market back on its feet, etc. So by process of elimination, that money printing and zero interest rates that we got from Bernanke and all the rest of this stuff, it's going to disproportionately benefit precious metals. And that's why for a couple or 3 years nearly, precious metals went nuts. Now what stopped the fun, and especially for the precious metals equities, was not that the Fed stopped printing, not that the Fed raised interest rates and stuff. They didn't do any of that. It's when, lo and behold, after 2+ years of money printing and zero interest rates, we finally got the recovery in the stock market. We finally saw the recovery in the broad economy and so forth. And so investors, once again, had something more to their liking and understanding to play with. All right, we made our money in the precious metals trade, but the fun's over. And since that day, we have not seen generalist investors get back in sufficiently to push the precious metals equities higher. In fact, and again for those of you watching by video, even though in the case of gold, the gold price is half again higher today, roughly, than it was at the peak in 2011, the most popular basket of precious metals equities, measured by the GDX exchange traded fund, is worth about half of what it was at the peak in 2011. And if you've been suffering for a long time as a buy and hold investor with a lot of good exploration stories, it's a lot worse than having lost half of your money since then. So the question is, what happens next to get generalist investors? Because that's who you're going to need, folks. If you're a gold bug or a silver bug, you don't want your gold and silver bug buddies. You don't want the people with you at the conference, eating the free food at the precious metals conference and listening to your favorite storytellers to see who can tell the biggest fable and conspiracy theory. You don't need them buying gold and silver. You need the people who aren't at your conference. You need the people who don't follow your favorite precious metals website. You need the people who think that cryptocurrencies are the greatest thing since sliced bread, who think that AI stocks and the Magnificent Seven and whatever moniker you want to use, to think those are great. And when those things start to break, those are the people who are going to have to come on board. And so what I believe is going to happen over a period of time is you're going to see, if for no other reason than the sheer overvaluation and exhaustion, and the realization that unless a deflationary crisis hits the U.S., like it's doing in slow motion in China, you're going to see this scenario we've gotten to be, unfortunately, too used to in the recent past, of chronically high inflation, chronically high interest rates start to hit the valuations, especially as the economy and its slowdown spreads. I've said many times already in recent months that if you ask half of America they believe we're already in a recession. They already see stagflation. They feel it every time they go to the grocery store, every time they buy their car insurance, every time they go to the gas pump, etc. And they all see that. Inevitably, because of the overhang of choking debt, let alone if the early days of Trump 2.0 seem to be ratifying the critics of President Trump, that all he's going to do with all of these wonderful extension of tax cuts and this and that is just add to the debt problem. You're going to start to see a lot of these other asset classes that have taken the oxygen out of the room to where nobody cares about precious metals. You're going to see that change, and I believe that you're going to see, as you did in late 2008 through 2011, by process of elimination, you will see these types of assets, gold and silver, both do well. And really along the way, if for no other reason, especially in gold's case, that even if things do hold together, even if the stock market plods along and doesn't have the kind of drop it did in 2008, inevitably debt still is going up and up and up, higher and higher all the time, worse as time goes on. And that means that gold is going to be viewed as a refuge sufficiently that it's going to start, I think, garnering the attention it still doesn't have, certainly not from the investment community. In fact, if you look at 2024, after a couple of glimmers of hope otherwise, this was another year. And think of this, folks, and this is how all of these other assets have really taken away from what is a better story than people have realized. ETF balances on a part of U.S. investors declined again in 2024. This is in a year when gold was higher by 27-28%, thereabouts. So it's backwards. Inevitably, that's going to right itself again, I believe. And so for the balance of this discussion, I want to talk about the things to do, the things not to do, and how to allocate whatever portion of your portfolio to precious metals that you and or your advisor think is appropriate. Now, before I take a really quick high-level lap through a lot of the don'ts and do's and the different ways you can invest in precious metals, the right way to do it, the wrong way to do it, I remind you again that I go into a lot more detail, number one, with all of this stuff. In the written version of This Is Still Not Your Father's Gold Market, so make sure that if you are not already on my email or social media lists where you'll be notified once that is available, make sure that you put yourself on them. There's information for how to do that in the notes to the show as well as here on the screen again. And secondly, though I'm going to talk about some general do's and don'ts and vetting processes for individual companies, I do already on my YouTube channel, which you should also be subscribed to, have a number of interviews in recent months with companies that are recommended already to my members at the National Investor. So in all of these cases, you'll get a lot more detail on a particular company involved. If it's still on my YouTube channel, it's still an active recommendation. And in some cases, you got some where the story's a little bit dated, but of course, if you subscribe to the National Investor, you get updates as they come out as well from these and all of my recommended companies. So make sure you follow that. And likewise, in the printed version of the National Investor upcoming, where I focus on precious metals, there'll be quick snapshots of several companies, some of which are my more recent recommendations in the precious metal space as well. So that out of the way, first I want to focus real quick on just a few of the do's and don'ts kind of thing, and maybe it's backwards, but I'm going to start with a couple of don'ts. First of all, be sure, whether you're a seasoned gold bug, you should have learned your lesson a lot on this already if you are. And if you're a novice in the gold space, likewise, be careful of where you get your information from. Now look, we all have market opinions. We all have opinions of where we think things are going to go or not go, as the case may be. But remember that a lot of gold and precious metals centric concerns out there and gurus out there, they're always talking their book, and more so they're talking their philosophy. They're 100% bullish on precious metals 100% of the time. And that's okay if you believe that philosophically. Philosophically, as I said earlier, I'm a gold bug. But as a practical matter, I'm not always a gold bug. There are times that I've advised our followers to bet against, especially the equities, as a trade. If I think that the gold or silver price, and especially in an overall downturn for the markets, if I think they're going to go down, I call things as I see them with everything. Even for something where I also am very opinionated and have a strong conviction in favor of precious metals by nature and by an entire lifetime of studying banking and monetary things. So don't think when I say that I'm trying to pick on somebody. But what I am saying is this, that there are some people out there who, it's kind of like if you need an entire new set of clothes, you don't just go to a shoe salesman. You might need underclothing, you might need a suit and a tie and stuff like that. But if you go to somebody who only sells shoes, that's all he's going to want to sell you is a pair of shoes. So realize that a lot of times you're getting information that is far from carefully researched and unbiased. You're getting something from someone, again, who with sincerity is talking their book. Worse than that, in some cases though, are people who are trying to promote precious metals and certain types of investments related to precious metals that really do know better than what they're saying. And for those watching by video, for those that are looking later on at the printed version of this, there's a few examples here I'm sharing on a screen, but there is just some outright outrageous come-ons that a lot of people have. The IMF is going to do away with the dollar because they're going to come out with a new currency. So, and here's the date they're going to do it. If you don't buy gold, you're going to lose all your savings. More recently, this clown and some other people are out there telling you that Biden was going to take away your bank account. You're going to have a new central bank digital currency called Biden bucks. Well, that didn't happen, and it's about out of time for the president to give us Biden bucks. So I don't think it's coming. And from time to time, the people with all these cockamamie, theories. I mentioned earlier the BRICS currency. I've explained that ad nauseum in a National Investor, that while there is a movement underway by a lot of the so-called BRICS nations to do more and more of their trade independent of the dollar, that's an important development when it comes to commodity supplies the world over and whatnot. But as far as anybody having any reasonable expectation that China, which would be the most logical country to do it, is going to be the anchor of a new global reserve currency, when we don't know if next week it's going to still it's going to have a functioning economy and markets, because it's teetering on the edge. The best that's going to happen to China for the next number of years to come is that Japanification process I've talked about. That ain't happening. So, especially in the case of some of these really dopey predictions, you get information from some of these kind of people. I've said this a million times: don't walk away, run, because they're too stupid or too disingenuous and sales oriented to give you good sound advice. That's number one. Number two, real quick, never, ever, ever buy physical metals that you don't end up with in your two own hot little hands or in your favorite hiding place that you tell nobody about. There's too many scams and high cost ways out there. Frankly, when you buy physical metals, and I'll get back to this in just a minute on the things to do and do properly, you want to have it in your hands. You don't want anybody holding it for you and so forth. I just don't think that's necessary. Number three, the biggest scam out there these days, and there's a new plethora of ads on this, are from people selling so-called gold IRAs. And here again, for those watching by video, you're seeing a couple examples once more of these kind of things, old ads and new ones alike. Folks, the single worst thing that you can do with your IRA or other tax qualified money is to buy physical precious metals. I'll say it again: the single worst thing you can do in precious metals is use your tax qualified money to buy physical gold. Why do I say that? Number one, there's a limit and certain types of coins you must buy. With your IRA money, they are the most overpriced out there, and typically these outfits will charge you 30, 40, 50% more than the spot price of gold is to buy these metals. Secondly, you're taking what is otherwise an anonymous asset, which in the case of physical gold or silver, as the case may be, should be in your hands if you need to use it as mad money, if the economy blows a gasket. Now it's not in your hands in most cases. So when you see these come-ons, that there's a special loophole. Ooh, did you know? The IRS has a special... The IRS has no special loophole for you to put gold proof coins in your IRA. The IRS generally, and this legislation's been around for years, changed the IRA custodial rules a long time ago, whereas they used to be that you had to have, garden variety bank account, insurance account, brokerage account, something like that, mutual fund as your custodian. You couldn't have physical. Hell, you can go out and buy a 56 Thunderbird, one of my favorite cars, okay, classic cars. You can have that and have your IRA money invested in that if you have the right kind of custodian. You can buy physical real estate. You can buy all manner of collectibles, and including certain kinds of gold coins. So don't think that this is unique to gold. And again, anybody making these come-ons to you, they're doing it because it's by far the most lucrative thing for them to scare you or cajole you or tug at your patriotic heartstrings or whatever to buy gold in your IRA. Never, ever, ever do that. And again, just like the charlatan types among the Pied Pipers of the Gold Bug Echo Chamber, I remarked on earlier, when you see these kinds of ads, don't walk away, run. Now let's go down a list of things to do when it comes to investing in gold. I mentioned physical gold a little while ago. Look, besides central banks in China and Russia and elsewhere, there are at least some Americans that are awake, because if you followed the news or maybe done it yourself, you know that a big story at places like the discount retailer Costco in recent months is that as fast as they stock up on precious metals, coins, and bars, they're sold out. So you got at least some people that are awake. And look, there's a reason why people over the years, not just because you're worried about, back then Y2K, not because you're worried about the nuclear explosion or anything like that. Of course, nothing's going to be any good in that instance. But people have always wanted to have at least some modest amount of gold and silver around to use as mad money. If tomorrow morning you woke up and the economy as we knew it had ceased to exist, and there's all kinds of risks, financial, technological, market, and otherwise, that we still face today. I don't like to dwell on them. I always say, be prepared to the extent you think you should and need to be, but don't dwell on what could go wrong. But again, in cases like this, I always have thought it's wise to have some modest amount of gold and silver on hand, but don't go overboard. When you buy it, buy scrap, older 1 ounce coins, older dollars, and so forth that are minted by the U.S. once upon a time. I'm not a big fan of junk silver, as it's called, where you can buy half dollars and quarters and dimes that were minted 64 and prior. Frankly, because a lot of people, if you had to use that to barter with, they're not going to take it seriously. But who knows today? If you give them a quarter, you give them a quarter. They don't know if it's before 1964 it's got silver content. So if you're going to buy things like that, buy more unique looking 1 ounce rounds. There's all kinds of companies around that sell them these days with higher demand from investors. The premiums aren't as low as they used to be for gold or silver. But be wise. Deal with a reputable outfit if you need any ideas. I don't have an axe to grind for any of them, but I do know of a few out there that are decent and will treat you right on the price, where you're not paying such an exorbitant amount of money over bullion as you would be on proof coins or, God forbid, rare coins, which incredibly a lot of people think they're supposed to buy for a crisis hedge. That's people that sell them for that ought to be shot. But that, again, that's another story. But again, don't go overboard with physical metals. I used to love to joke, especially back in the days when I was on the Y2K circuit and talking about what Y2K might or might not do to the markets, to precious metals and whatnot. I would love to aggravate some of the more ostentatious gold bugs by saying, all right, you stock up on gold and rare coins, and I'll stock up on tobacco and whiskey and dried food. And if things happen, they're the worst scenarios of Y2K, and we're in a wilderness economy for a while, we'll see who can barter the easiest, and I'll bet you it's me. So gold and silver have their place, but don't don't go overboard. Secondly, if you don't want gold and silver in your hands, or you don't like the idea of stocks or think the stock market is going to take everything down, but you still think, especially in the case of gold, it's wise, there are a number of ETFs and funds out there that are proxies for the gold price. So you're not buying physical gold directly, you don't have it in your hands, but you buy it for the gold price. There's a couple of exchange traded funds, different symbols. My favorite one is the ProShares UGL, which I've used more as a trading vehicle over time. It has more of a volatility complex to it than ones that are not leveraged. So over a period of time, and I've explained this and will again in the written part of this issue of this is still not your father's gold market. These leveraged bullion funds, if you've got a good sustained move higher in the gold price, will give you a lot more bang for your buck. So that's an area, if you don't want to get involved in storing gold, but you still like the idea of at least the metal, you can do that. And of course, where silver is concerned, AGQ is the symbol of the ProShares Leveraged Silver ETF, and that's one that we've used as a trading vehicle from time to time. Now, beyond all that, when it really gets fun, at least it used to, is where equities are concerned. But there again, this is why I say this is still not your father's gold market, because in the past, if you had had a move like you did in 2024, for example, and the gold price itself was up 27%, gold stocks should have been up 50 to 75%. They couldn't even match the performance of gold, let alone if you were in exploration companies and you were down on the year. So things have changed, and again, it's because the constituency has changed. You don't have as big a percentage of the investing public that will latch on to the gold-related equities or silver-related equities, as the case may be. But that said, I do believe that we're going to be moving into another period of time where these things are more constructive, and so where gold equities are concerned. Again, if you, as I said with the ETFs on the physical bullion, if you don't want to be a stock picker, or if you think with at least a core position where you don't want to have to give it a lot of thought, you do have a variety of mutual funds and exchange traded funds out there. The best one is GDX, or the best known one, I should say. GDX is the larger miners. GDXJ is the Market Vectors Junior Gold Miners Fund. There's some overlap in there because, again, there's not much of a universe of gold stocks out there and not as large a market cap as with other segments of the stock market. So, but anyway, these are good vehicles to get into, and sometimes you can look at them from a buy and hold standpoint, but over the years I have tended with these things to use them to increase our overall portfolio weighting if I think it's during a time that we should be doing that. I'll give you an example of this. If we go back to 2008 and 2009 time frame, I always am looking for and always have at least a handful of individual companies on my list where I worry less about what the gold and silver price is short term, because these are stories I think are superior enough that I'm willing to ride the ups and downs. But beyond that, if I think that the general environment is conducive, I'll go to a higher weighting. In the National Investor, I have recommended allocations of a portfolio, how much in cash, how much in stocks, etc., and how much in different types of stocks, be it conservative income-oriented ones or more speculative ones. We actually peaked at about a 35% total portfolio weighting, which is a lot higher than you're ever going to hear from a garden variety financial advisor back in early 2011. Before the month of January 2011 was over, we had cut that allocation to precious metals related holdings in half. And most of that was by getting out of the ETFs, or at least reducing our positions. By year end, we were back down to 10 to 12%, I think, which is frankly where most people start if they're a generalist financial advisor. They say, okay, well, 5 or 10% in precious metals. Well, no, there's times that more than that is required and called for, times that you shouldn't do that. So, but again, these, in my view, and the way I look at them, these are more as allocation vehicles, and you don't want to ride them forever. You can ride them for a number of months maybe, but you don't want to ride them forever. It's the most fun, frankly, And the most profit to be had, if you pick the right ones, is by investing in the individual companies. And those are ones that either, number one, follow through with the promise and make a big discovery, or later, number two, later, number two, are able to get all of the pieces, including the financing, in place to develop and start producing and hopefully at a profit. So these are the two biggest things that investors traditionally look for. Pierre Lassonde, a well-known mining executive of many decades duration, has laid all this out on what he calls the Lassonde curve. And as you see here on the screen, if you're watching the video, you've got two major times during the lifetime of a project, from initial exploration to development production, where you have the biggest gains. And that is, number one, when you have the biggest wow factor. And sometimes it's in phases. It might not all be in one fell swoop. But be that as it may, you've got the biggest wow factor of, holy cow, a big discovery was just made. And for whatever reason, this is way better than what you typically see in a company. So if you've got a really needle-moving discovery, that's still going to garner attention and a higher share price by and large, even during a time like this when not all generalist investors are interested. In fact, very few of them are. Secondly, and this is even more important today, to large investors and institutions, it's the simple catchphrase, show me the money. And even in the case of smaller projects, and I've stressed this a lot recently, especially in the context of a couple more recent recommendations of mine, even if you don't have multi-million ounce deposits, do you have a project that clearly, once it's developed, or maybe now has been developed and you're demonstrating it by cash flow, is it one that is going to do better than a crowd and actually bring in free cash? Is it one where you're going to have bottom line earnings, and maybe to the extent that you can pay some money back to shareholders? Because that's what people are looking for. If you're watching this video and you're not one of the religious gold bugs, what do you want to see? And I would suspect that it's two things. First off, like I said, a big discovery that is, really does have a wow factor for some reason or reasons attached to it that is worthy of people being interested in that particular company. And more so, especially these days, it's show me the money. Can you produce something at a profit? Because there's a lot of instances over the years and a lot of stories where companies, and some of them are frankly disingenuous about how they do this. They put out news that they think is great exploration news, great assay results and so forth, but never in a million years is that volume of gold they may be reporting in assay results ever going to be recovered, and sometimes for a variety of reasons. So real quick, and again, I go through a lot of this list in the printed version of this special issue. There's just some basic things you need to look at when you're looking at a company. First of all, is a theme I love to repeat from time to time, and that is bet on the jockey. Simply put, you want to find people who, for this particular company that you might be looking at, for whom this is not their first rodeo. And there are some good people and good names in the industry who more than once have taken something from scratch, they build it up, they've proven a resource, and have sold it to a major like a Newmont or to a mid-tier company like a Kinross or whoever, and made their shareholders piles and piles and piles of money. Those that have done it once are more likely to do it again than the executives who can't point to any such thing and are running these so-called lifestyle companies on a shoestring. So you always want to look at management. You want to look at their ability to raise money. For some years now, especially since that big peak for mining equities generally and a sentiment around them since 2011 that I pointed out earlier, it's been pretty slim pickings at times. It's been tougher to get investment money, generally speaking, into most any kind, not just gold and silver, but into a lot of different kinds of resource, development, early greenfield work as it's called. And that's been for a lot of reasons. Again, there's other areas of the markets that have demanded attention. And look, if you're a broker or you run a bunch of brokers at a big investment house, you're not going to keep your job very long if you're operating based on your opinion of what gold, for example, should do. And there's a lot of examples in recent years of investment houses that used to have more people and more money dedicated to exploration. Even in countries like Canada, which more so than the U.S. Is more of a resource-centric economy, and they've cut back. So you don't have the budgets, you don't have the personnel or anything that you used to have. So that's been a problem. And look, later on, that is going to accentuate the fact that with a lot of different commodities, even gold, you've got this peaking production worldwide, frankly, where it's going to start to roll over, and there's not going to be enough money to discover new resources that are going to meet the demand of what's going to come years down the road. So this is a problem, but it's not as big a problem as some have made it out to be. So one of the things I like in my follow the jockey theme is, especially when even with small companies, certain people never have a problem raising money. And some shareholders, when juniors aren't being followed that much, they might carp about it and say, "Well, yeah, but you're raising money at too low a price." Look, if somebody's able to raise decent money in a kind of lousy market it's been in the recent past for juniors, it means because people with brains beyond what you and I have vetted these properties, they love the management, they trust them, and they're willing to put money to work in projects because they see the promise that's there. So, in my job of constantly talking to companies and vetting them and trying to put all these different pieces together, and if I get enough positive check marks, okay, I may even recommend them. From time to time, I'll hear ones tell me about how terrible it is, they can't raise money, they can't do, okay. More often than not, a company that can't raise money doesn't have a good enough project or capable enough management to garner money. So keep that in mind. Besides the jockey and whatnot, there's a lot of other things that come into play. Certainly the type of a project that you have is important. More so, can it, if you've got XYZ company flushing out a resource, how realistic is it that it's going to be produced and produced at a profit? There's a lot of things to look at. There's a lot of factors to mull over. So you got to kick the tires, look at it from a sensible standpoint, or have somebody that that can do it for you. Jurisdiction is a lot. There are good jurisdictions, there are not so good jurisdictions. Infamously in the U.S., there are certain states that it takes forever to permit something. Even those that are more mining friendly, like Alaska and Nevada. So that's a consideration when you're looking at investing in a company. And even in states like that, is the project on private land? Is it on public land? Who oversees it? I've been talking separately in the recent past with the incoming administration that the whole environment for permitting projects and for getting rid of some of the duplicative roadblocks that we see so much, that's going to improve for the better. So all else equal, wherever you are in the U.S., for example, you're going to have a better environment. In some instances, you have land, whether it's in the U.S. or in Canada, where you've got First Nations in Canada or Native American peoples in the U.S. who may have a say in the project going forward, so make sure they're on board. One of my more recent recommendations is a great story in Alaska, where they not only have the Alaska Native Corporation on board, but as a direct investor out of the corporation's own pocket in their one of the better exploration projects right now out there of anything that I know of. So that's a consideration. And don't be afraid to look at some other places outside of North America. I happen to think that because of a lot of the moves that President Trump is going to be making, and because of the vast resources down there to begin with, that South America generally is going to start being viewed by investors in the U.S. as something that maybe they should pay a little bit more attention to. A lot of people, for example, over the years have ignored a fact like Chile, which single-handedly provides the biggest whack of copper that the U.S. uses for its economy. But there's other companies down there too. Some years back I was a first mover among my peers in Ecuador and made some early huge profits on a couple of breakout companies down there as that country is starting to put together its mining industry. There are dangers there, as we've seen since then in Ecuador. But there's still a lot of upside to even a country like that, which has got a lot of violence right now, narco violence, and all of the upheavals down there, but still vast resources that are largely untapped. And I think a government right now, which if you held the election today would be reelected, that is going to try and keep things going in the right direction for the benefit of the country's own coffers and the tax receipts and whatnot that will come in, and for the benefit of the Ecuadorian people. So again, that's a quick lap around some of the major factors that you look at in betting a project. And the question for the average investor is, how much of a portfolio should I have in things like this? I think that precious metals generally should command a larger portion of your portfolio today than I think the average financial advisor would suggest to you. In fact, elsewhere you've probably heard me say recently that my three favorite sectors are uranium, natural gas, and gold. Silver will get pulled along with gold, I think, if we have an especially big move. But those are my three favorites. So needless to say, old energy in a broad sense, and precious metals and uranium. Uranium of my current recommendations is probably number one as far as the allocation to it. And it's probably old energy is number two right now, oil and gas and pipelines and things like that. And gold and silver is probably number three right now, largely because we don't have a big ETF presence right now in precious metals. I think that as far as the sectors are concerned, that, and I'm speaking in general terms, that there is some near-term danger. I think that if the overall stock market corrects further in the months ahead, which I think is more likely than not, under the average scenario, even if that helps the precious metals prices themselves stay elevated, the stocks are more likely than not to get dragged along at least somewhat. So I'm a little cautious, but that said, my long-term prognostications for both gold and silver remain very bullish, very constructive, simply because central banks and governments aren't changing. And all of the reasons I said earlier on are still there, and even more so than what we had before. So where it comes to individual companies, this is a time, especially since they are so cheap compared to their larger peers and compared to the metals prices themselves. It's never been as cheap as this in my entire career. You do want to take positions in some of the better stories out there. So again, when you see the printed version of This Is Still Not Your Father's Gold Market, you'll see profiles of a number of the companies on my current recommended list. Or if you go to my YouTube page, you see some videos where I've interviewed management of the stories there as well. So that's it for this edition of Your Money Today. I hope it's been instructive. As always, I welcome your comments and questions, and some of them will answer in future episodes of Your Money Today. They'll all be answered individually if they come in, and some will also have the questions and answers in the next issue or so of the National Investor. So thanks for tuning in, folks. We'll see you next time.
We're glad you joined us today. As always, write to chris@nationalinvestor.com with your comments and questions. And be sure to visit yourmoneytoday.org if you haven't already. Sign up for our free alerts, notifications of new shows, and more. Thanks for tuning in, and we'll see you next time.